It's a pleasure to be with you all. I guess I'll lead us off. So I'm Mark Davis. I'm on staff with the World Bank. I'm based in Washington, D.C. And I'll introduce this topic with a few minutes of a presentation. I want to express three really key thoughts. So as I go through a series of slides, hopefully these come through. First, I want to talk about what is patient capital. So that's a term you don't always hear. So I want to just talk about what is that and why is that described the way it is. Second, I want to talk about saving, but not just saving for saving's sake, but also turning it into investing. So I want to get that concept across also. And then finally, I want to talk about safety and governance. And I want to make you think about what actually safe assets are, and I'll show a slide or two that gets to that concept. So this idea of what can institutional investors do on the continent, the OECD put out a work just this year on capital markets, and they had four key things that they would say that capital markets or that institutional investors can do as part of capital markets. They can be catalysts. That's an important role that they can play. They can improve the depth of capital markets. They can increase stability, and I have a little anchor up there because that's what we're focusing on here. They can increase stability because they increase investor confidence and also the resilience of markets. And I'll talk about why that is. And then finally, they can help address the infrastructure gap that we face on the continent. So this will be a little small to read, but the essence of it is this idea of not just saving, but saving in order to invest. So if you think about how does it work for especially insurance companies and pension funds, what they really are doing is they're taking individual savers and they're taking their money and investing that money as asset owners. So pension funds, insurance companies, they are the asset owners in this picture. They then in turn, in many countries, will then hand some or part or all of that, those funds to external asset managers who then make decisions about companies and projects to invest in. Those companies then have boards that oversee how that money is invested. And then finally, they tell their management how exactly to do that in a way that generates better profit. That profit turns into dividends, which then come back to the individual savers. And those individual savers can then invest again or save again and give more to be then reinvested. So it's a virtuous circle, and it's a multiplier that has rounds and rounds of impact in an economy. Patient capital. So why is this capital so appropriate for being patient? Well, if you really think about, especially pension funds and insurance companies, they are making extremely long-lived promises. They're making promises easily that get 20 and 30 years into the future, and even in some cases 50 years into the future. So for them, if they have cash flow streams that are not going to really need to be paid off, so to speak, promises that need to be fulfilled for 40 to 50 years in the future, they have they have the luxury of time, and they can put their money in instruments other than just short-term assets and cash. They, in fact, would be most responsible, most astute if they go ahead and put their money in equities, in infrastructure, and perhaps even a bit in property. So they have the luxury of time, and they should make use of this kind of illiquidity premium to earn extra returns on the funds that they're responsible for. So these are just two slides that illustrate the power of what pension funds can mean in an economy. This is data from the OECD. You're not going to be able to see individual country names, but if you look, the bottom 10 countries on this list have pension fund assets in excess of 100% of GDP. So these are countries with trillions of dollars in GDP, and yet they have pension funds that exceed those amounts. And so pension funds can be very significant in terms of what they can do as institutional investors in an economy. This next slide, really the key thing to see here, again, very detailed, but the blue part of each bar is the amount of equity that makes up that country's pension fund system. So if you look on the left-hand side, those are OECD countries, and on the right-hand side, those are non-OECD countries. This is all data the OECD gathers. What you can see is countries like Poland, Estonia, a number of other countries have almost entirely equity in their pension fund portfolios. And there's examples from non-OECD countries as well. Botswana has quite a bit of equity. The Seychelles, other countries, Morocco, they show up with quite a bit of equity as part of their pension fund portfolio. So just to give you a picture of the fact that pension funds frequently will go outside of this box of just government debt and bank deposits, it's actually more typical that they venture into more of these kind of higher yielding investments. On insurance, quickly on insurance, they also will play in the equity space and get out of just government debt instruments. Especially life insurers, non-life insurers, and to a lesser degree, composite insurers. They'll have a slice of equity, 8, 11, 6%, but they're also able to put money into other types of investments. They have collective investment schemes that probably have equity underneath. So both pension funds and insurance companies can be quite significant. This slide, my chart didn't come through, but the essence of these two slides that I'm about to show is just the fact that there is an increased need for local investors to have local institutional investors to be more significant players in economies, because there's been a dynamic of foreign investors quickly receding from some of the emerging economies whenever anything bad happens. So basically, the chart here showed that during the global financial crisis, during the taper tantrum, and then more recently during the pandemic, a dramatic amount of money was quickly withdrawn from local emerging economies. And so if they don't have institutional investor kind of size of some magnitude, then those kind of investments are going to be whipsawed by the fact that this foreign money is coming out so quickly. This slide really shows the same thing. This was very recent work done by the IMF, where they surveyed a number of countries that have a significant amount of local currency debt. And what they found was, going back to 2013, almost every single country that they surveyed, the foreign investment share was at or very near the bottom of that 12-year stretch. So there's really been a dynamic of foreign investors pulling back, and that's why it is so important to have an increasing magnitude for local institutional investors. So governance and safety, let's talk about that a little bit. What needs to be true? One point to be made is that, as an example with pension funds, they have a very specific first job, and that job is to pay pensioners and then their beneficiaries. So they can do a lot of other things. They can be effective infrastructure investors, but they should be given the latitude to make their first job truly their first job, and then to do other things when those are complementary. So that's a little bit of a theme I like to reinforce, because sometimes pension funds are asked to behave like development banks, sometimes to the detriment of pensioners, and that shouldn't be what happens. Instead, the pension funds should be allowed to do their first job first, but because they have such long duration and patience, they can do many other things and on a complementary basis. So what is a safe asset? Usually when you ask someone that, they'll say, well, T-bills or perhaps a bank deposit where I'm guaranteed a certain amount of return. Well, I would suggest that for pension funds and insurance companies, that's untrue. That's actually incorrect, because they have these 30 and 50-year time horizons. So here's a chart that takes data from the US, because that's where you have the longest data streams. This goes back 90 years, and it looks at equity, bonds, and T-bills. And on the left side, the blue bars are the range of outcomes in terms of 1 year results for that 90 years. On the far right-hand side of each section is the red bar, which shows the range of outcomes for 20-year holding periods. And basically, if you look at this data closely enough, if you say, these are nominal returns, if you say average inflation is going to be about 2%, well, actually, the only responsible thing that a pension fund or an insurance company could do would be to hold equities, because that's the only asset class that actually is guaranteed to beat inflation over 20 years, if you believe 90 years of data. The others could possibly destroy value based upon how 20-year holding periods have turned out. So rethinking your definition of safety is a very important thing to incorporate. So governance is very important. Again, we have a chart that doesn't show up very well here, but basically the point of this chart is cash and bank deposits are very easy to govern, are very easy for a trustee board or a governing board to look after, but they also could destroy value after inflation. So for the pension fund, for the insurance company to do their job more appropriately, they are going to have to gain capacity, gain skills to be able to look after some assets that are a little more complex, but ones that will have a better ability to beat inflation and to deliver an after inflation true value add over 20 and 30-year holding periods. Canadian pension funds, great examples. Again, a chart that didn't work. I'm not sure why, but basically this chart showed that a number of the pension funds in Canada back in the 1980s and 90s had almost entirely government debt. But then if you look at them today, they are some of the most diversified pension funds in the world. And it didn't happen overnight. It's not like one day they had all government debt and the next day they suddenly had an incredible amount of different asset classes. That had to be a process that took quite a bit of time. They gained strength in their governance. They gained capacity. So it's a process, and it's one that's going to take a number of years, but it's a worthwhile one as has been shown in the Canadian model. Another kind of, I'm reinforcing the same points, pension funds and insurance companies. This is a researcher who looked at the structure of their balance sheets as a way to understand, well, why is it that they can be so counter-cyclical? And he basically found the structure of their liabilities in terms of kind of claims from households, policyholders, pension fund beneficiaries, was one that gave them this incredible amount of latitude and ability to take to earn illiquidity premiums over many years. So it's an interesting advantage that they come to market with. Great book, Investing for the Long Run. Just a couple thoughts here about pension funds and insurance companies truly having the ability to be counter-cyclical. They can be, Warren Buffett has a famous saying, he's scared when everyone else is greedy, and he's greedy when everyone else is scared is the essence of it. And that's the essence of what these authors are talking about. These authors are talking about things like rebalancing. So when equity has run way, way, way up, well, it might be appropriate to then take some profits. And then also, you have to have the strength of governance so that when things look dire, your governing board will have talked about that ahead of time and will have the strength of will to sit tight if that's the most appropriate action. This is just research that in general shows that pension funds do act in a counter-cyclical way. So again, when I say counter-cyclical, that means they're going to stabilize your markets. And that's something you desperately want to have if you're looking for more resilience in the markets, as we talked about earlier. So good bit of evidence for this. I'm going to finish with an example about a specific type of investment vehicle that's gaining a lot of prominence in defined contribution funds around the world. So many pension systems are turning from defined benefit to defined contribution, so savings as opposed to just a pure promise. And in the United States, the way that this is now being increasingly implemented is something called target date funds, where you would have a specific fund that you would be a part of based upon when it's projected you will retire. So anybody who provides these funds has to have about 10 of them to cover their whole workforce. And so these have increasingly become the default instrument in the US. And the impact of this is that younger employees, 20 and 30-year-olds, are increasingly holding a lot more equity because the way these things are structured, it's thought that they should have at least 90% equity for someone in their 20s. So the impact of it, as these funds have grown to be 3.5 trillion in size, and they keep growing, is that there is a lot more of the equity universe in the United States held by basically retirement plan participants who don't intend on doing anything different with it. They're content to sit there because that's how their fund has been designed. And so last slide, some researchers have recently looked at the global financial crisis, what happened as far as flows of assets, and then they looked at the pandemic, early 2020, and they have found, given the much more significant amount of target date funds and really passive investment in general that exists in the US, there was a lot less of trend following that occurred during the pandemic kind of problems. Basically, when markets fell in the global financial crisis, people were quick to run to the exits. When the pandemic happened, that really didn't occur. The correlation is much less significant. It goes from, I think it was 78% down to only 0.06%. So that's dramatically different and just shows the power of how pension funds can truly be stabilizing influences. Thank you.
Thank you for that excellent presentation. So that gives us kind of a good way to start on how these kind of institutional investors work and their role in capital markets. I'm going to kind of divide my questioning into three themes. We have local kind of institutions here, the two pension funds. So Ethiopia has two public pension funds. In terms of government-run pension funds, one a public one, a private one. So we have representatives from both institutions, and then we have a representative from the insurance industry. So that gives us the local context, and then I'll go to the Rwandan pension fund regulator, and then the Rwandan capital market regulator to give us kind of local regional country experience on how they've kind of leveraged on these institutions. And then I'll come back to you, Mark, to give us some pointers or guides on how to get these ideas that you presented and make them applicable to Ethiopia. So maybe I'll start with Ato Talahun. Ato Talahun is the Director General, is the Deputy Director General of the Public Pension Fund. So Ato Talahun, maybe if you can give us some context for the audience on the changes that have happened in the last 4 years in pension funds, how they're run, the new proclamation, the new regulation. Talk about how you're planning to leverage and use the capital markets.
As frequently mentioned, pension funds are one of the largest institutional investors. Again, when you talk about the pension fund, we are talking about trust fund. We are managing the fund of the scheme members. For instance, in Ethiopia, in the public pension scheme, we have more than 3 million pension scheme members, and we expect to keep the interests of our scheme members. So, when we manage the pension fund, one of the basic issues that should be raised is safety or security. It is very important. That's why for the last 40 years, the public pension fund has been invested on government security. Almost 100% of the fund was invested on government security. The benefit is it is 100% secured. But if you look at the challenges we face during the last 6-7 years, the pension fund was not even able to pay the benefit to the pensioners because of the depletion of the pension fund. So based on that, we have undertaken a pension reform during the last 4 or 5 years, which is mainly aimed at sustaining the pension fund and enhancing the adequacy of the benefits to the pensioner, and actually raising the issue of governance. These were the major challenges that the pension fund faced during the last 5 or 6 years. So this pension reform was very important to maintain the sustainability of the pension fund. So what we did was, in the pension funds, there is what we call it an actuarial study. Actuary is a science which is mainly aimed at projecting the financial status of the pension. So we, in collaboration with ILO, we have undertaken an actuarial valuation, and based on the result of that actuarial valuation, the major finding was, unless the pension fund investment is diversified, it will get depleted in the coming 50 years. That was one of the major findings of this actuarial study. So, to address the challenges that I mentioned before, we did a reform on the regulations and the proclamation we used for a long period of time. So, one of the amendments on the pension proclamation was to give the power to the board. The issue of governance was very important in our pension fund because before the reform, the board has the power to make strategic decisions on the investment portfolio. So we just only invest on government security. It was just filling the deficit of government budget. So based on that, the portfolio mix was also improved, and an investment strategy was prepared and approved by the board. So now, apart from the government security, the portfolio mix has been diversified, and even the return has been increased. Just for a comparison, some 6 years before, the return from Treasury bill was less than 2%. Now, it is about 13.5%. You know, the policy rate is 15%, so we are approaching to the policy rate. So there is a very significant change after having undertaken a pension reform in terms of increasing the size of the pension fund and even the benefit we pay to our pensioners. So the issue of adequacy has also been addressed after undertaking the pension reform. And almost for the last 5 years, we are increasing the benefit for our pensioners every year. So we can possibly say that there is a remarkable achievement in raising the sustainability of the pension fund. Now the size of the pension fund is increasing. We are expecting to bring the pension fund almost $500 billion, probably at the end of the year or at the mid of next year. So this is a combined effort of the reforms undertaken in the pension fund.
Thank you so much. So that gives us kind of the context of, the last few years of kind of changes that have been implemented and what's happening in the pension funds. So I'll go next to Tobarugude, who's the Director for Investment for the private side, the private workers insurance pension fund. So maybe if you can touch on the differences between the two funds. So the private side tends to be much younger. What is the implication? And then how do you plan to use capital markets based on kind of the reforms that have already been implemented, as Ato Tlaun just told us?
Thank you, Ato Sraq. Also, I thank you, Ato Tlaun. He has represented the reforms around the pension fund. Ato Sraq already mentioned there are two types of pension funds here in Ethiopia. One is public social security pension fund, and the other one is a private organization employees social security fund. The private, I am representing now the private organization employees social security fund. and which is very young when compared to the public. Public has the long history back, but in the private sector, we have started 12, 13 years back. It is very young as such, 13 years young, but growing at increasing rate from year to year. When we started in 2011, 12, it was, it has took 5 to 6 years to collect 30, 40 billion per. But nowadays, we last year collected 40 billion per a single year, 1 year, that means. So in this year, we are planning to collect more than between 50 to 60 billion per. And the other year it will continue. So the size is now increasing. It is around 200 billion right now as I speak. So I'm not telling you the size now existing one, but it is increasing, it is growing at an increasing rate. This 200 billion where we collected for the last 12, 13 years, will be collected in the coming 4 years, 3 to 4 years. So it is a patient fund. It is an opportunity for us to expand and to participate in capital market with growing assets. As Talon mentioned, actually we are investing in government securities, so most of our assets also too, and that's also the existing platform. There are no other capital market opportunities in this country, as we all know, as we discussed since morning. Now we have an opportunity of a capital market platform. And when we go into the capital market platform, I think we can stabilize, as most of the speakers before me talked about in the morning. We have ability, we have power to stabilize the market. We have power to compete and to hold more assets, and also to bring more and more capital and assets into the market, and also to make beneficial our subscribers. Our subscribers are, at this day around close to 2.5 million subscribers we have. And we are also adding more and more subscribers joining in daily basis. So now in the coming years, this fund will be a very big fund, and this is an opportunity to the country, it's an opportunity to the capital market, and also the subscribers, especially the retired population of this fund will benefit a lot from it. Right now, we don't have such very much liability right now. It is 20 plus years we have just to pay. And right now, it's less than 5% of our collection, annual collection, is paid for beneficiaries. So we have an opportunity to invest in long growth assets while keeping also our investments in government securities. And the opportunity for diversification is one of the annual collection is growing in annual basis. Without touching even our assets in government securities, we can diversify also our assets with different capital market products. So now we are just looking for collaborators and stakeholders working together to strengthen this opportunity and also strengthen the capital market activity. Thank you very much.
Thank you, Azubarkuti. Based on Mark's earlier presentation, so the other kind of anchor institutional investor in capital markets are insurance companies. So when we think about insurance companies in Ethiopia, and if you ask anybody on the street, what do? They collect premiums and pay, make payments when a claim is made. I mean, that's probably what everybody knows about insurance. I know Ato Yared, who's the CEO of Nile Insurance, will probably disagree. They're quite, especially if you look at the market worldwide in capital markets, insurance companies are large investors. Institutional investors, of course, their product base will limit on how much or the scale they participate in. But maybe, Ato Yarid, if you can give us a background of the insurance market in Ethiopia, one. And number two, how do you see your role in participating in capital markets, within the context of that business?
Thank you, Sarak. I think calling that insurance is in the house would be enough for today, but insurance, because of its unique nature of its business model, insurance are positioned as large, steady, long-term institutional investor, as we've seen it in the presentation. But also they have a dual role of also as a major institutional buyers of the capital market products. So we are both on supply side and also the capital, demand side. So this will put us in a unique feature. To answer your question, let's have a quick snapshot of our market. In insurance, we have two metrics to just evaluate the insurance performance. One is what we call insurance penetration, and the other one is density. Insurance penetration, what we mean is the contribution of insurance to GDP. And density is about premium per capita. So both metrics will tell us that Ethiopia, despite having a very huge potential for growth and development, still those metrics will tell us that it is substantially low, even by East African standards. But why? One of the essential ingredients for the growth of insurance is the long-term insurance product. Let's look into our markets. The long-term insurance, or what we call life and health, only contributes 10% of the aggregate gross premium generated in our market. A recent study shows that why is Ethiopia underperforming in long-term insurance, which will directly take us to capital markets. Look, we need long-term is it's a long-term in insurance. Basically, we'll collect premium today and pay claim later. And in life insurance, basically in long-term insurance, it may take decades. So there is a huge opportunity for long-term investments. But in our market or industry, we are tied up with traditional investment vehicles like time deposits and minor equity issues and treasury bills. So we don't have a product that match our long-term liability. So the existence and the coming into place of capital markets is a very good news, so that we have a long-term instrument to match our long-term liabilities. Of course, there is a pressure from, we have regulatory issues that we've been forced to remain very liquid, like 65%, according to our current regulation. We're forced to be liquid like 65% of cash. And imagine with the current inflation rate, that's always alarming, as a big headache of insurance CEOs currently. And also availability of those other vehicles. For instance, there is a recent tax regime that imposed more taxation on time deposits. So insurance companies will be paying other vehicles, other capital market instruments. will be coming whether we like it or not. So, but it has to be faced. It has to be faced. because of, as I told you, because of the regulatory requirement, and also the short-term pain and pressure from all our investors. And so we need to match up that, and so we need to have a phased approach. But I want to also emphasize that we also expect from capital markets two critical elements. The capital charge and the liquidity buffers. That's also very important. So we need to focus also those elements. And also, it's a very good news for the market that a lot of insurance companies are now thinking to be listed, to be on demand side. So they will be actively participating in the liability market. Hopefully, we'll see a lot of numbers in the coming months and days that a lot of active players on both supply and demand side. Thank you.
Thank you so much. So we've heard from the insurance and the pension funds in Ethiopia. So I would like to move on to kind of the pension fund players in the regional context. So Ms. Doris is with the Rwandan Pension Fund. So I want to get some context. So you've gone through this kind of exercise, early day development of participation, increasing participation in capital market products. So how did you do it, and how would you advise our pension funds to transition in a kind of systemic way, obviously addressing the concerns that were raised earlier, but at the same time, with the increasing amount of money flowing in, and both pension funds being very young in terms of their liabilities, how would you suggest we move towards transitioning into some investment in capital markets?
Thank you very much. Good afternoon, everyone. Firstly, I'd like to introduce who RSSB is. We are Rwanda Social Security Board. So our mandate is twofold. The first aspect is to ensure we provide optimal returns to our members. And then additionally is, while we do this, we ensure we are creating a meaningful social impact. So as an institution, we are the largest, but we are member first and data driven in terms of achieving these objectives. So having said that, so we have a social angle, and based on our report, we've actually created about 250,000 jobs for the Rwandan people who are our members and represent about 90% of the population. So having said that, in terms now of investments, we invest across all asset classes, and I represent one asset class, which is equities, which provides the patient capital, as was highlighted at the beginning of the presentation. So how would advise in terms of just transitioning from an RSSB perspective? So we've been anchors in terms of investing across all the asset classes. As we stand right now, we manage about 2.2 billion US dollars. 20% of that is unlisted equities. So that means that we have to, we took up the mandate to actually develop our own markets by investing in our own businesses and entrepreneurs so that we can drive that growth in the country. In addition to this, we do invest in government securities, but we also invest in corporate bonds. And how we've done this is having conversation with issuers, the corporates in Rwanda, and focusing on why it is important for them to perhaps obtain funds from the capital markets. And so what we've done is we've invested in some of these companies, and also we've encouraged them to list in the Rwandan Stock Exchange so that they can actually get additional funding by listing from other investors. Yeah, so I think.
Thank you so much. So that's a large size pension fund. participating successfully in capital markets. So it's doable. And then a much larger economy. Obviously, Ethiopia is much bigger than Rwanda. So you can see kind of the opportunity, a capital market represents for our pension funds in Ethiopia. I want to move on to Mr. Tapelo. As a regulator and sitting as an advisor to a regulator, what are the kind of steps we can take to promote the safe participation of these institutional investors and transitioning their kind of product mix to capital market products?
Thank you, and thanks for a wonderful conference. I think speaking from the regulator's perspective, especially in some of the markets, not only in Rwanda, you realize that most of the countries that he showed that have got significantly large pension funds, some of them transitioned by actually designing some of the prudential regulations which were done by the regulators in terms of investment for pension fund. So you realize that, in order to avoid what he was saying, that, sometimes you put too much money on government bonds and the returns are not enough. And maybe also to correct him that indeed government bonds also in Africa, there have been cases in Ghana where government is not able to pay 100% and therefore they're not safe. So the best option will be some of the regulators of pension fund to actually have some prudential regulations in terms of investments. That if you have 100% of the asset, you can put a maximum of maybe 20 in fixed income, maybe 50 in equities, and maybe 20 in other instruments. And over and above that, you look at a lot of other countries, especially in the southern part, they've also even split the mandate in different formats. I know in Botswana, pension funds are allowed to invest a minimum of 30% in the economy in Botswana, but they can also take 70% outside. But of course, they are reversing that now to 50-50. Because, the intention really here is to grow the pension fund. And, sometimes the economy is stagnant. So if you only keep money in domestic economies, whereas the money could be getting some much more returns outside, I think it doesn't add a lot of value to the pension fund. But of course, with some strict sense of measures taken into place. And over and above that, I think the risk mitigating factors also are also put in place in the sense that, there are always limitations in terms of even in equities. If you have like 10 companies listed in Rwanda, they'll be restricting that you can't take 10% of your equity portfolio to one company because you need to spread around the risks. So I think that is the regulatory aspect from my side that I look at it. Over and above that, I think sitting from a regulatory point of view, also I think you need to have standards in terms of the caliber of people who get into the pension fund as trustees. I know there have been a trend in some other African countries that some of these people are political appointees to get in so that they can channel some of this investment to some of other places. So I think as regulators also, some of the things from best markets practice in some of the African countries is that there have to be some standards in terms of who can actually be a pension fund trustee. In terms of the qualifications and also in terms of the expertise. I think that also will bring a lot of balancing act between the pension fund and also with the view that people can actually look at the administration part. I think those are one of the two things that I can actually suggest from the regulatory point of view.
Thank you so much. So I'll come back to you, Mark. So just if you can give us kind of 2 or 3 pointers on what are the kind of key steps you suggest our institutional investors should take? Short term to medium term, if you can identify one for each, for instance, would be great.
I think that's the right way to think about it, short, medium, long term. Just turning the switch day, one and trying to move from a 90% government debt, 10% bank deposits into, a incredibly well-diversified portfolio is just not going to work. It needs to be done gradually. So it needs to be done perhaps 5 to 10% of the portfolio to put into new asset classes to begin with. And probably that needs to be done with the support of some level of consultancy or at least external managers. So I've seen pension funds around the world. Malaysia is a great example where they're very large. I think it's 250 billion US nowadays. Their EPF pension fund, as they got into new asset classes, they always would use external managers to begin with, but they also had a parallel path plan in some cases, not all, but in some cases to build internal capacity, to figure out how to then manage those asset classes themselves. So those kind of measures, and then, looking first at things that are possible in your local capital market. It's hard for a pension fund to unilaterally just blaze new trails. So doing it with co-investment partners is always better. Doing it with the support of perhaps some level of guarantee or at least partnership with some of the international organizations is always helpful as well. So again, kind of doing it gradually, leaning on external support, being content. And let me just say one thing about some of the slides I showed. As an example, I think it was Poland was at the very top of their pension funds in general hold like 80-90% of equity. I don't think the pension funds here would ever do that. I think you'll always have a solid block of government debt, but you do need other things. You do need these assets that can beat inflation on a consistent basis over those kind of 20-year holding periods that I talked about. But to get there, start slowly and lean on external support, and I think it'll play out well in the end.
Thank you, Mark. So just in the interest of time and for the other sessions that we have in the afternoon, I'm going to end it here. But kind of from my side, with the presentation, hopefully you have some takeaways on what we're trying to do as an institution and how the capital market can help, even on the investor side, help the capital market grow by kind of growing the institutional investors that we currently have. I want to thank my panelists for coming out today, and I apologize for all the lateness for you and the audience. Thank you so much for listening to us.